Something wrong with the world today. I don't know what it is. Something's wrong with our eyes. We're seeing things in a different way. God knows it ain't his. It sure ain't no surprise. We're living on the edge. Living on the edge. Living on the edge.
Good afternoon, everyone, and welcome to today's review of the third quarter and take a look at going forward in the fourth quarter and beyond. And today's webinar is titled Living on the Edge, because I get the feeling that in many ways we kind of are living on the edge right now. In economic terms, you can make an argument that we're about to fall into a possible recession, in the next 6 months or year. On the other hand, there are arguments that the economy has kind of reached its low point and can improve from here. So we'll be talking about that. We're also living on the edge in terms of politics, with our president, Trump, facing possible impeachment, although that's unlikely to happen. But at least a year out, in the next election, at least at this time, you're looking at possibly Trump returning to office, or maybe someone like Elizabeth Warren, which would bring the country in two completely different directions. So in terms of politics, we're also living on the edge. So today we're going to review the Q3 performance, look at some economic indicators, some valuation measures, and take a look at going forward. So the stock market, and this is as of Friday, the 18th, is close to its all-time high. It's been rallying a little bit, and you'll see a series here of higher lows, but also we seem to be putting in some lower highs. So we're effectively creating what's called a wedge pattern, and often when there's a breakout from this pattern, either higher or lower, the market can have a decent move one way or the other. In terms of quarterly performance based on the different style boxes, large growth was the leader in the last quarter, up 2.5%. And small growth was on the tail end, with actually a negative performance for the quarter. In terms of sectors, investors were moving into utilities and real estate because those sectors have decent yields, and fixed income returns were declining. So as fixed income went down, that attracted people to utilities and real estate. Looking around the world, Japan was the winner in the last quarter, up 4%, but you'll notice it was down. It was the worst performer in the 3 quarters prior to that. And in terms of fixed income, for the second consecutive quarter and for the third time in the last 4 quarters, long-term treasuries were the winner. And you look at this, long-term treasuries, often they're either the top performer or the bottom. So having been the top performer 3 of the last 4 quarters, maybe it's a signal that interest rates have bottomed and will start to go up from here, but time will tell. Let's take a look at the economy, and we've been looking at this chart for several of these webinars, and you'll see that the leading economic indicator, which is the blue line, is starting to flatten out. The coincident indicator, which is the red line, is increasing a little bit, but the gap hasn't closed that much, which you see here on the chart on the right. But we look at this to see if the LEI is going to start to decline while the CEI continues up, and that would be a signal that we're possibly getting closer to a recession. This is the business confidence survey, which is actually a subset of the LEI, and you'll see here business confidence is way down. In the past, that's definitely been a signal of a possible recession. And the Treasury spread, the 10-year versus the 3-month, this is as of a couple of weeks ago. It has been inverted, but in the last couple of weeks, actually, it went above 0. So this is no longer inverted, but as we've spoken about in the past, an inverted yield curve has been a leading signal for a recession. This is from the New York Fed, which actually looks at the probability of a U.S. recession by looking at the 10-year and the 3 months. And the August reading came in at 38%. You'll see this is going higher and higher and higher. And normally when you get to such a high reading, like over 25, that has been pretty good signal for future recession in the next 12 months. Initial claims for unemployment are in good shape. The labor market, for the most part, continues to be strong. So here we haven't seen an upturn yet. Non-farm payrolls, this is the hiring for non-farm payrolls. It's the percentage change from last year. Has not really turned down from last year. It's kind of flattened out, hasn't broken through this support line right here. But in the past, when it has turned down, that's been a signal for an oncoming recession. So it looks like it might turn down, but not yet. U.S. light vehicle sales are hanging in there. They've been pretty steady at about 17. Here's the ISM Purchasing Managers Index, which has fallen below 50. It's at 47.8 on the last reading. A number below 50 is considered contractionary. So this certainly is not a good look for going forward for the economy. However, manufacturing is only about 10% of the U.S. economy at this point. The threat is, or the worry is, that the problem in manufacturing will bleed over into the services, which did happen in the most recent non-manufacturing PMI, which is here. And you'll see it fell a lot, higher than 56 to 52.6. So this is still above 50. But it seems to be indicating, like many of these other indicators, that the economy is slowing down. Heavy-duty truck shipments have turned down, and the last couple of recessions, that's been a good indicator. The high-yield spread is still pretty low, hanging in there at 4.28%. This is as of a couple weeks ago, and I think the most recent reading, as of yesterday, was even lower at about 4%. So this, so far, is not indicating a future recession. This is GDP growth. This is as of October 1st, it's 1.8%, and the most recent reading this past week was still at 1.8%. And here we look at GDP growth, and you'll see how the trend has certainly been lower since the second quarter of 2018. The trend is definitely lower. It's expected to get lower in Q3 of 2019, and Q4 of 2019, the New York Fed's nowcast is forecasting growth right now of only 1%. In the fourth quarter. Here's the Global Purchasing Managers Index for manufacturing from around the world. If you look at the global number, it actually turned up from June. It went up by a little bit. So that would be a good signal. We'll see if that continues or not. And in emerging markets, it went north of 50. So it fell just below 50 and now is up over 50. So those are actually good signals. Now, if you look around the world, we have 9 countries below 50 compared to 11 in June of 2019. But you'll notice the overall trend is still, we had a lot of green in here, and it's gotten more red as we have gone on in time. Hopefully, these PMI indicators are showing that we have reached a bottom and a turning point. So I would say this is somewhat positive at this point. The stock market, as represented by the S&P 500 in the orange line below, has tended to follow roughly the assets that the Federal Reserve holds. And you'll see that as the Fed began to sell off its balance sheet, the market stopped pretty much going up and went flat for a while. It started to go up in the last few weeks, and the Fed has now announced that it's going to be buying about $60 billion in short-term treasuries over the next few months. They're not calling it quantitative easing. They're saying that they need that to basically make the banking system function properly. There was a big problem with repurchase agreements in the last few weeks, and the Fed had to jump in and throw billions into the market so that there was enough liquidity. But the net effect of this is, with purchasing an additional $60 billion a month, is going to increase the balance sheet of the Fed, and that should be favorable to the market. So that would be a factor in the S&P 500 going up. Here's a look at earnings estimates, and you'll see how they've gone down. So here we show the 2020 and 2019 estimates at the beginning of the year, the end of 2018, 193.31, 173.90. This is where we are today. So the 193.31 is now at 181.91. The 173.90 for 2019 has fallen all the way to 163.56. Both down about 5.9%. And it looks like earnings this year is going to be close to flat with 2018. Expected to go up a little bit in 2020 and then a lot in 2021. Over time, these estimates do tend to come down, but earnings estimates have consistently been falling week by week as we chart them. This chart looks at the PE ratios. This is the closing price of the S&P 500 as of Friday, October 18th, and here are the most recent earnings estimates. So the PE ratio as of now is 18.33. That's higher than the average of 16.5, and the forward PE is 16.49. Now, practically speaking, this number will probably come down more, but at least as of today, it's 16.49, which is higher than the average since 2004, 15.62. So this would show that the market is maybe a little bit on the overvalued side, but on the opposite side, the 10-year yield is only 1.76%, and that compares to a 3.04% 10-year yield average. So when you take that into account, the market is probably, fairly valued at this point. Here's the earnings yield minus the yield on an investment grade bond, and as this graph goes higher and higher, that would be more favorable to stocks, showing that you're getting a better return in stocks as compared to bonds. The earnings yield is the flip of the PE ratio, so it's the earnings divided by price, and you'll notice it's gone up and up and up over recent years. So this would be something favoring investing in stocks. Here's the 10-year Treasury yield minus the yield on the U.S. stock market, and the stock market is yielding 1.88%. This is as of September 30th. 10-year Treasury was yielding 1.68%. So you have a 20 basis point advantage owning stocks, plus you get growth with stocks. Whereas owning a bond, you would just get the yield and then return the face value of the bond at maturity. Now, of course, theoretically, if stocks were to decline in earnings, you could also get the negative impact of that. But if stocks and businesses continue to grow, you get the yield plus the growth along the way. So this would indicate that stocks are a better value at this point than treasuries, at least based on how things have happened in the past. Here's the Morningstar median fair value. This is as of October 3rd, and the median stock in their universe was valued at 96%, a little bit less than the fair value of 1.0. So this would also be something to show why stocks are a little bit of a better value at this point. Here's the value line estimates. Going out 3 to 5 years, it shows an appreciation potential of 55%. And that's not the greatest number of all time by a long shot, but it's a little bit higher than it was in July and April, and way up from what it was in January of 2018. This chart looks at gold, and we're looking at breakouts in gold. The price of gold broke through resistance points. So here in 1979, broke through. You had a really big run. Here in 2006 or so, broke through the resistance from 1982, had it set up a decent run, broke through resistance again around 2008 or 2009, going through the resistance from 1979, 1980, set up a good run. And here we just broke through the resistance that was set up on several prior points in the last several years. So my point here is that when gold in the past has gotten through these resistance points, it's generally led to a good run. And this might make sense as the world seems to not care about budget deficits in the U.S. or anywhere overseas. There's all this talk of modern monetary theory, which is basically code word for unlimited spending. So as currencies around the world are debased and lose their value, this might be an argument why you might want to own something, or at least a little bit of some gold. Here's a look at the Fed funds rate going back to 1955, and prior to other recessions, you see that the Fed funds rate was constantly rising for a decent amount of time before we got into a recession. And that is what was going on for the last couple of years. The Fed was very, very slowly raising interest rates, but from a historical point of view, they're still very, very low. And then in the last few months, they started to ease and lower the rates a little bit. So the question is, did the Fed take their foot off the accelerator in time to prevent a recession? So let's talk about where the market might go from here. And this slide is pretty much the same as the last time we did this in July. At that time, we said don't fight the Fed. We thought there was a slight lean towards the market going up, and we would continue with that viewpoint for right now. But there are definitely reasons why the market will go higher. There are reasons why the market will go lower. But the truth is, nobody knows what the market's going to do. The market's going to do what it's going to do based on factors that people just cannot anticipate, or they can't anticipate how the market will react to it. So reasons why the market might go down is if the trade war picks up from here. We had a little bit of a ceasefire in the last couple of weeks, and hopefully the ceasefire holds, and then we can actually improve on the tariff situation from there, and we can get back to more of a free market around the world with lower tariffs, which would improve growth prospects everywhere. The threat of a global recession, if that continues, that would push the market down. Global tensions, political hotspots all over the world, in China, Iran, etc. The threat of impeachment, maybe that would push the market down, but I also put that on the positive side because that might push the market up. Inflation, if inflation was to break out, that would be a negative. It's something that nobody is anticipating, so that would be a surprise event that would push up interest rates and hurt the market. If bond markets start paying attention to the U.S. deficit, which doesn't seem even possible at this point, but that would be something that would also start pushing up rates and hurt equities. And just general psychology. Psychology could turn on a dime, and the market would feed off that, and that could push the market lower and lower. And of course, the biggest one is the risk of a U.S. recession. There's a chance that we'll be able to avoid a recession, and indicators will get higher from here. And if that happens, that would push the market up. But if we do slide into a recession, that would represent a possible sell-off in the stock market of 25 to 50%. Of course, nobody knows, but that's what has often happened in the past with a recession. So that would be a big negative. Reason why the markets might go up, we already spoke about it, don't fight the Fed. You have easy monetary policies here in the U.S. and around the world. There's about $15 to $17 trillion in negative yielding sovereign debt around the world, so that's providing support to equities. If the economic indicators begin to turn around, if the Fed began to ease in just enough time so that we don't slide into a recession, that would help. Of course, if the trade wars cease and get it better from here, that would certainly help the economy. We need interest rates and inflation to stay under control. No major mishaps in Washington, and we already mentioned the impeachment proceedings. Anyway, that's it for this webinar. If you have any questions, please feel free to reach out to any of us at BlueKey or at Envision. And thank you very much and have a great day.